Okay, so we're good to go.
Hi, my name is Chantal Sanchez. I work with Pacific Sotheby's International Realty in Palm Springs. And today we're with actually my really, really good friend and one of my closest friends for forever ago when we met in Chicago 10 years ago, Eileen Ward. Eileen works for Bernstein Private Health Wealth Management. She's the VP and the financial advisor. She's pretty much a woman that I really admire and someone that it's funny do you remember we used to talk about how we're going to be bad, like bad biatches and really get out there and work it out. So it's just nice to know that you've succeeded. I'm very, very proud of you.
Thank you so much. Thank you for having me. And I mean, we would be remiss not to mention that I'm the godmother to your daughter. I mean, that
That's
was
right.
like the most meaningful, I think one of the most meaningful things that has come out of our friendship. So going back to like 2009, post college when we met in Chicago,
Yeah.
and we're so early in our careers, and where we've gone since then. And one of the things I love so much about our relationship is just getting to be part of your family remotely.
I really appreciate that. And I wanted to say too, what's interesting is when we first met, we were actually right in the beginning of another economic turmoil that from a decade ago. So it's kind of interesting to see that spin back around. So Eileen, what would you say now with everything going on? I mean, of course, this is such a difficult, broad question, but what would you say is the state of our economy right now?
So the economy is in a very tenuous situation. There's a big disconnect to what you read about the economy, where we talk about things like GDP and growth. We're most certainly in a recession, meaning
Okay,
we're a consumption-driven economy. I mean, when we have money, we go to the store and we buy things, right? Or
right.
we take advantage of services that are offered to us. We can't fly. I mean, some of us can fly, but most people aren't risking it right now. We can't enjoy the social activities at restaurants like we used to, but there have been beneficiaries to this, and you and I are doing a Zoom meeting right now, and technology has certainly been a beneficiary. So depending on what segment of the market you're employed by, you may be unemployed right now. And I think one of the best things that we saw our government do, which was a delineation between what we had in 2008. The government kind of took a while to get stimulus going and to employ monetary policy to make the markets more liquid. What we saw in this situation was swift bipartisan action. We have seen tremendous support, both from Congress and from the Federal Reserve to keep markets liquid and to keep people in their homes, right? You've seen, we were in a housing crisis and people were being essentially evicted and,
Right.
going into bankruptcy. The government didn't want that to happen, albeit they knew there was going to be a tremendous spike in unemployment. Unemployment is at the depression level, depression levels at this point.
Right.
So
I think it's even like surpassed that. I think what we're 38 million people unemployed right now in the United States, something like that.
it's really scary and it's really sad. And even though we're talking really positively about the potential for a vaccine, and I know all of the governors are putting in place different phases to go back to work based on whatever's happening in your local economy. What we're seeing in the capital markets, though, is very different, right? We've seen certain styles outperform versus others underperform, like a growth versus value, for example. US versus international. The US is, while the market is down, the market bottomed, supposedly. It could go down again to, March 23rd levels, but really where we're at today, the S&P is only down roughly 8%. We're
Really?
basically, we're basically back to the levels that we were at last summer. So if you didn't pull out of the market, right, if you stuck to a plan, like, most financial advisors like myself would advise, if you weren't trying to get in and get out and time the market, you're probably in a pretty decent position to just stay the course and meet your goals. I mean, most people don't just have the S&P in their portfolio. They have a variety of different
Sure.
strategies and allocations. So when I quote being down 8%, chances are if you're an investor right now, your personal portfolio doesn't only look down 8%. There's other assets in there, but people who stayed the course have enjoyed the benefit of a swift recovery thanks to the influx from the government.
Right. So you're saying that that definitely helped out with the private sector as well.
Tremendous.
What would you say is the main difference? You know, like I said, talking about how we knew each other from 2009 or 2008. When is there a big difference from?
Yeah, there's a
Okay,
huge difference because what we did to ourselves in 2008 was a systemic crisis, right? People who should not have been buying very expensive homes were borrowing money that they couldn't support. And when interest rates go up, there was the whole cascade effect of
uh-huh,
and a lot of those securities when mortgages and collateralized loans get securitized and they go into retirement accounts. There was a terrible systemic issue at heart. This is what we call in economics an exogenous event. And while we're all really unhappy with the state of the economy right now, even though the markets appear to have made a decent recovery, we're definitely not through the woods yet.
sure.
And this was when people say we're in this together, we really are in this together. This was a shock to everybody. We went from being at the lowest unemployment rate we've ever had to the most robust growth era we've had to, like you said, depression era unemployment overnight and a stalled economy. So it's very different. And the hope is that those fiscal and monetary stimuluses help build a bridge to get us through to when things start to recover.
That's really, really good to know. And I've heard that too, you know, even in real estate, on the real estate side, we keep saying like everyone's waiting for prices to crash and prices just aren't dropping. And it's funny. I mean, we're seeing a little bit high. Of course, you know, it's almost like real estate has been on pause right now, to be honest with you. However, we're seeing a huge influx of new listings, new contracts. People are still buying, even though you know, some people are holding on and expecting a huge drop, like 20, 30% drop, just like we had in 2008, 2009. However, at this point, we're only seeing kind of a price correction and maybe of a, you know, 5% price correction. So I agree completely. And I think that the real estate market totally reflects what you're saying, what happens in the private sector, in the financial and in the investment side too. So now also to kind of going into investments, given this kind of economy that we're having right now, what kind of investments would you suggest or advise your clients right now?
So let me do the fine print. Everybody's different. So when I build
Sure.
a plan for my clients, I am very into understanding what their unique circumstances, what they come to the table with, what their goals are, what their tax picture looks like. So
Sure.
everything I do is, objectives and goals based, and everything I build for my clients is bespoke to them. We don't use cookie cutter models at Bernstein because everybody who walks in the door is an individual. That being said, if I'm just broadly highlighting where there's dislocation in the market, where there presents opportunity, if you're a long-term investor and you happen to be sitting on cash, I mean, the problem is a lot of people's cash dried up. People wish they had more cash right now to
Right.
deploy. That's reality. And if you don't have cash flow coming into your business, what do you have to invest with? But let's pretend you're one of those people who wants to try to be a little bit more tactical. I would say on the risk spectrum, you have bonds, which are the ballast to manage risk in your portfolio. They're often income generating, so we still like municipal bonds because the Fed has said that they're going to continue supporting that sector moving forward, and the supply and demand picture, the technicals look very supportive. So we like municipal bonds. We also like high yield bonds. There's absolutely risk associated with them, but the way we think about high yield bonds, which is a company issuing debt, and that company comes with risk. And so usually you generate income above that of a treasury. And right now, the spreads, as we call it, that's just
Right.
lingo in my business, the risk associated with buying into a corporation and hoping that they can afford to pay their coupon to the borrower
Right.
or to the lender, I mean, those are very, very wide. And traditionally, when spreads are at these levels, often for the next 6 to 12 months, high yield bonds tend to outperform US equities, and they have somewhat similar risk levels. So that's an interesting trade we're talking about right now, maybe taking a little bit off the table in terms of equities and favoring or adding a little bit more. Again, everything is always on the margin. We don't take big bets because our clients are long-term investors.
Sure.
And for folks who, can afford, and we typically work with qualified purchasers at Bernstein, meaning, the SEC and the IRS defines these people as having $5 million of net worth or more. For folks who are qualified to invest in private markets, I got to be honest, those are the most compelling areas to be investing right now. Not for nothing, there are 13,000 publicly traded companies globally. That's wonderful. The capital markets are very efficient, but where there's inefficiency is what you were talking about earlier, is all these private companies that are perhaps struggling as a result of COVID and this quarantine. And what private market investors like private equity or private credit have accumulated over the past decade is a lot of cash. So we all know cash is king right now.
Of course.
And being able to invest where you have the ability to employ specific expertise in a sector to make and enhance operational changes by adjusting board positions, by really just improving the business, you can really improve the valuation of a company. So we really like private markets. Unfortunately, you have to be able to tie up again, it's reserved for folks who have significant wealth, because you have to lock up your money. When you buy the S&P 500, it's almost like you're renting, right? If you and I were to own the index right now, you and I aren't having any impact on those 500 companies that are in our portfolio.
It's short term.
Exactly. You're just hoping that they do well and that you're diversified and that that segment performs. Whereas in private equity, there's a lot more value creation that can be achieved. And typically $1 million investment in public equities. So we think public equities will generate roughly 8% a year. I mean, it's not going to be a straight line, but if we say roughly 8% going forward, at the end of 20 years, $1 million in the S&P would turn into roughly 4.7 million. If a private equity strategy can generate 11% instead of 8, right? Call it 300 basis point or 3% premium every single year, you're likely to achieve over that 20-year time horizon an $8 million.
Wow.
So there's a huge difference between public and private markets. And so if investors have the capacity to tie up some liquidity and take advantage of inefficiencies in the private markets, whether that be private equity or private credit, there's a lot of interesting ways to make extra money.
And especially right now.
Right, because there's never been a bigger need. It went from being a great seller's market to a great buyer's market.
Well, and I could say that it's kind of the same too in real estate. However, I would say that because of low inventory, like we mentioned, that's the only thing that's really keeping it from being a true buyer's market. Although we are seeing some buyers with a little bit more power, but still a lot of sellers are also holding off on their prices in real estate. And especially in larger cities like Los Angeles, New York, Miami, where, these cities are in demand. But really quick and last question. Thank you so much, Eileen. I mean, this is so informational, and I really, really value it because, I didn't really mention in the beginning, you have such a huge line of resume is incredible. You started at JP Morgan, you've done over 7 years at Goldman Sachs, and now you're at Bernstein, and you're just you're a wealth of knowledge yourself. So, and being a woman, what would you say, what kind of women do you work with in your industry and in what you do?
Yeah, thank you for asking. So my practice focuses very heavily on executives because they have interesting compensation structures, and that brings a level of complexity where Bernstein can add value. And then certainly entrepreneurs who I find are monetizing their businesses effectively, or often exiting their businesses. A lot of entrepreneurs have a lot of wealth tied up in their business, and given the prevalence and the activity in the private market space, whether it's a strategic or private, taking on some growth equity in order to, improve the trajectory of your company, that's been a very relevant trend. So that's where I tend to insert myself. But as far as women go, and women are executives, women are entrepreneurs these days, I would say there's kind of 3 types of women where a relationship with Bernstein can somewhat be meaningful, and it's wealth creators. So, a lot of women who are heads of household, they have a dream, they're pursuing it and they're crushing it, and they find themselves in a position in need of financial advice. By all means, I seek to work with those type of folks. But
Right.
there's also, quite frankly, inheritors, right? So if you think about, who in your family maybe had the means to leave an inheritance and bequeath money to you. We all think of like the Rockefellers, like multi-generational families that
Right.
wealth was created. And it's typically through expert planning that wealth lasts through multiple generations. So women often find themselves the beneficiaries of trusts and inheritances, and they want to think very mindfully when they finally come into the wealth, how it's invested. And I find that a lot of the women I work with are into sustainable investing or responsible investing. They're not only focused on the returns. Well, of course, returns are important. We're in a
Sure.
quantifiable business. It's something we compete on. Um, what's your impact on society? Those are a lot of conversations that I have with my female clients. And then you could be the spouse. I think we were joking before we started recording this that there's a lot of women who are CEOs of their household, and just because you're not the prime breadwinner doesn't
Right.
mean your values are dismissed. You actually take on a more powerful role in terms of your consumption choices and the values
Absolutely.
you transfer to your children, right? Because I think something that we've come to realize is that when you first create wealth for the first time, that's life changing. And mistakes can be very, very expensive
Oh,
because
yeah, absolutely.
the first time you come into wealth, if you're not prepared for it, we've all heard really sad stories of somebody who had their moment in the spotlight, but it didn't last. And so I really, seek to be of value to people who maybe do take on a more proactive role, even if they're not the breadwinner in the relationship. So that's
Absolutely. And
really
that's what we were saying. We were saying, just because sometimes when you deal with for some women, their spouse is working full time and they're at home, but and that's why I mentioned they're the CEO of the house, because a lot of times these, men or their spouses would be focused on their business or their career. And so they don't really have time for the day-to-day financial activities in the house. So oftentimes these women are, paying the bills, looking up the credit, and making sure where do we lack and how are we doing healthy financially. Now, you mentioned something really quickly previously about sustainable investments. What do you mean by sustainable investments?
So thinking about, and this is specific to Bernstein, we have a whole platform that allows investors who want to access the capital markets, but do it in a more mindful format, to access responsible investment. So thinking, and we align ourselves with the UN sustainability goals, because that's an out there means of, they're written down, they're recorded, they're measurable. So both from a fixed income perspective, again, risk management and income generation versus growth, which is what you are seeking to get out of equities. Wherever you are on the investment spectrum, we have investments that we have used extra diligence, right? We look at the company through a different lens, right? So a lot of companies, we're always, if we're invested in a publicly traded company, we're shareholders, but we look further than the shareholders at the stakeholders. So the customers, the employees, all of the different stakeholders outside of just the shareholders, and how that business treats its employees, its customers. And we measure and quantify those things, and we value them more highly when we're constructing a portfolio. So it's very, very research driven. But one of the most incredible things that occurred, and we were only able to witness this because we haven't had a big correction in such a long time. We did at
That's
the end of
true.
2018, but it was kind of short-lived. We bounced back pretty quick. In this correction, which was very severe, we have found that responsible investments have outperformed more mainstream investments. So you're almost thinking about it when you de-risk a company by looking a little bit deeper at some of these characteristics and through these lenses. And so it's popular amongst millennials, it's popular amongst women. I certainly have male clients who embrace these types of strategies. So it's not just women, but it's a tremendous trend that's picking up steam. And when the performance numbers come through, it's impressive to see.
And they're happy, and then you have happy clients.
Yeah. Yeah. And then, that's what we aspire to, is our clients are very forthcoming with us about what it is that they want for themselves and their families. And it's up to us to build a roadmap and a plan that we take the journey together. Investing is a lifetime journey. It's not a once and done kind of
Right.
experience. It's an iterative process because people change companies, they change careers, life happens. I mean, you've lived through many of these circumstances in your own life, and
Uh-huh.
we all grow as individuals. And so that's why a financial plan kind of needs to be a living, breathing thing. And we hope to be the living, breathing resource that helps you through that journey.
I think you're absolutely right. And I think a lot of people don't understand that. Like you mentioned, sometimes people come across a large amount of money and then they don't invest it correctly and they end up losing all of it. So you have to make your money work for you. It's very, very important to not just work for the money, but also have the money work for you. Um, one of the um, uh, one of the books I've read that really influenced me was The Richest Man in Babylon. It's an old book, but it still is valid today. And I just remember one of the things that, was one of the first things said in the book was pay yourself first, which means, when you're buying things, when you're, it's paying off debt, you're paying other people. You're not paying yourself. And paying yourself means investing in yourself. And I think he said 10%, automatically put 10% back into yourself, back into your investment. So I'm sure you have a huge strategy, and like you said, based for everyone, but that was an eye opener for me, financially, is to pay yourself first.
Yeah, I love
So,
that. And like to piggyback on that, here's like one thing, and it's, whether you're wealthy, getting there, or you feel that you never have enough, everybody has their own journey. But the one thing that we're all very keenly aware of is how much money we make. And
right,
I think like we all know our number, but most people don't know their net worth
right.
and they have no clue what they spend. I may be wrong. There's some of us who keep very tight budgets and we're really on top of it, but a lot of people don't know what they spend. And a lot of your investment success is predicated on, lifestyle choices and ability to tolerate risk. And those are some of the levers that we have to help our clients get to the outcomes they want. So anytime I'm doing analysis, I always have to ask my clients what their spending habits are. And I find that a lot of people have to go back and check their credit card statements multiple times or check the app they use to kind of keep themselves in check. It's really easy for that number to be really big in certain years, or, we're
Oh
tightening
yeah,
our
we
belt.
know that. We know. We all know. I think at some point in our lives, we all have been there where we're like, oh gosh, I really spent $200 at the restaurant. Like, what did I buy? It happens. But yeah, you're right. It's just being more aware. And people tend to be kind of scared of money. It's funny. We want money, but then once we get it, we're scared of it and we don't know how to invest it properly. So anyway, I again, thank you so much, Eileen. You are just again, it's such a wealth of knowledge, and it's so nice to have you on here. Maybe we'll try to have you more often. I'll definitely be posting your link and your website, so if people want to get in touch with you, they'll be able to ask direct questions for you and hopefully reach out with more. Maybe they would like to make an appointment with you. So I hope that we can make that happen. But again, thank you. And we'll try to do this, maybe once every quarter or something, and kind of see how the economy goes. You'll be my little financial advisor.
I love it. I am happy to do that. I think, anybody who tunes into this, I appreciate the chance to get to know you. And Chantal, I know your business is growing very, very quickly. And so appreciate the platform to introduce myself and, know that you're one of those women out there who's the wealth creator and who I am very incentivized to be supporting. So keep it up. Thank you for the opportunity
Thank
and
you so
look forward to
much.
keeping in touch.
Thank you. Thank you.
Take care.